Welcome back. Today I'm examining what I believe is a massive structural shift happening right now in the cryptocurrency landscape. On one end of this equation, you have an aggressive supply scarcity developing in real time. On the other end, you have a looming wave of massive institutional demand that's quietly building momentum. I was looking at the accumulation numbers for Tom Lee's Bitmine in my analysis, and they absolutely blew me away. The Ethereum numbers in particular really caught my attention. It looks like they're pulling a staggering amount of Ethereum directly out of circulation, treating it less like a tradable currency and more like a strategic digital land grab. In my view, it's a massive land grab that most retail investors haven't fully grasped yet. I'm talking about them holding over 4.47 million ETH right now, according to my analysis. And here's what's really striking. They aren't slowing down. Not at all. They're actively buying between $50 million to $100 million worth of Ethereum every single week, without any signs of stopping. Think about what that means in practical terms. That is a massive chunk of the total circulating supply just vanishing from the open market on a routine weekly basis. $100 million a week is wild when you really sit down and calculate the cumulative effect over time. And they have the war chest to keep this up for the foreseeable future, right? My analysis mentioned an $800 million cash reserve just sitting there on their balance sheet waiting to be deployed. What's fascinating to me here is the sheer strategic advantage that kind of volume provides to a single entity. $800 million in cash gives them the ultimate market flexibility. They can just wait for optimal conditions. Exactly. They can wait, carefully watch the market dynamics, and execute a major purchase at the exact right moment, when selling pressure is exhausted. In my view, when you're pulling that much supply out of an already tightening ecosystem, a perfectly timed buy could trigger a sudden upward price jump simply due to immediate market scarcity and the resulting panic from short sellers. And here's another layer to this that I think is often overlooked. They aren't just hoarding this Ethereum under a digital mattress somewhere. They're earning a massive staking yield on every single coin they hold. The staking component is absolutely critical to understanding their strategy. Basically, they get paid interest just for locking up their ETH to help secure the network and validate transactions. And then they're taking that passive income and using it to buy even more Ethereum in the open market. Exactly. That makes their holdings highly productive capital rather than idle assets. They take that staking yield and immediately reinvest it into more accumulation. It's a self-reinforcing loop, a completely self-sustaining loop of compound accumulation. The more they hold, the more they earn, and the more they earn, the more they can buy. In my opinion, this creates a flywheel effect that becomes increasingly difficult for other market participants to compete against. Here's where my analysis suggests things get really interesting. Because while Bitmine is aggressively vacuuming up the available supply on one side of the market, the demand side of the equation is quietly positioning itself for what I believe will be an absolute explosion in the coming months. I'm talking about the traditional banks entering the space in a serious way. The big player outlined in my analysis is JPMorgan, which happens to be the largest bank in the United States by assets. And they are now publicly backing something called the Clarity Act, which is proposed legislation aimed at establishing clear regulatory frameworks for digital assets. If I connect this to the bigger picture of market evolution, having a traditional powerhouse like JPMorgan openly pressuring Congress for clear rules is a massive validation signal for the entire crypto ecosystem. It's a huge signal that the old guard sees the writing on the wall. Let me explain why this matters so much in practical terms. Right now, there are literally trillions of dollars in institutional capital just sitting on the sidelines, watching the crypto markets develop. These fund managers and institutional investors want to get in, but they can't because of regulatory uncertainty that could put their licenses at risk. They need the regulatory green light before they can deploy serious capital. In my opinion, passing the Clarity Act would provide the exact green light these massive institutions need to participate safely, legally, and in a compliant manner. And when JPMorgan talks about getting into digital assets, they don't just mean buying Bitcoin for their corporate balance sheet as a hedge. Wall Street wants to unlock something much bigger, which is tokenization. By that I mean they want to put actual traditional capital, like real estate deeds, corporate bonds, or even traditional stock market equities directly onto a blockchain infrastructure. This concept is truly revolutionary when you think about the implications. It is. Imagine being able to trade a fraction of a skyscraper in Manhattan the same way you trade a stock right now, instantly and with global liquidity. That's the vision that's driving all of this interest. But Wall Street won't play until the rules are written in stone and legally binding. Precisely. You cannot move the plumbing of global capital markets onto a distributed ledger without absolute legal trust and a defined regulatory framework that has stood up to scrutiny. JP Morgan's public stance on the Clarity Act tells me they're fully prepared to adopt and scale this technology the moment Congress finally establishes those legal boundaries. In my view, they're not just preparing for a future possibility, they're actively positioning to dominate that future. So what does all of this mean when we put the pieces together? If Wall Street gets the green light to flood the market with trillions of dollars of institutional capital, and companies like Bitmine have already hoarded a significant portion of the underlying supply, aren't we just looking at a massive bottleneck forming in the market structure? That is the exact convergence point that my analysis is warning investors to pay attention to. On one hand, you have a rapidly tightening supply of Ethereum driven by corporate whales locking up assets and staking them for yield. On the other hand, you have the imminent threat of a massive influx of institutional demand waiting to be unlocked by federal legislation that could pass at any time. Combine those two powerful forces, and my analysis suggests the fundamental market conditions are perfectly set for a significant price expansion that could catch many people off guard. In my opinion, what you've outlined represents one of the most compelling structural setups the digital asset market has seen, because it highlights a rare convergence of tightening supply mechanics and strengthening institutional validation. The idea of a single entity aggressively accumulating over 4.47 million ETH and consistently deploying $50 to $100 million per week signals not just conviction, but a long-term strategic vision that treats Ethereum as core infrastructure rather than a speculative trade. When that accumulation is paired with staking, transforming holdings into yield-generating compounding capital, it creates a powerful flywheel that reinforces scarcity while steadily expanding ownership. That dynamic alone is impressive, but what truly elevates the thesis is the parallel movement on the regulatory and institutional front. When a financial heavyweight like JP Morgan Chase publicly supports clearer digital asset legislation, such as the proposed Clarity Act, it sends a strong signal that traditional finance is preparing for meaningful integration rather than passive observation. The prospect of tokenizing real-world assets and migrating portions of global capital markets onto blockchain infrastructure represents an evolutionary leap for finance, and Ethereum stands at the center of that narrative. If regulatory clarity unlocks sidelined institutional capital, while significant supply is already staked or strategically held, the resulting supply-demand imbalance could create powerful upward pressure. Overall, this alignment of disciplined accumulation, productive staking, regulatory momentum, and institutional positioning paints an exceptionally bullish long-term picture for Ethereum's role in the future financial system.
Thanks for watching. If you found this helpful, hit that like button and subscribe for more.